So the playbook around diversification stopped working. And frankly, that's been true for a lot of this decade. And right now, bonds are down for the year, and equities are still up. But the fear of inflation is everywhere.
All right, joining me will be Andrew Beer, managing member of DBi, who is behind the iMGP DBi Managed Futures Strategy ETF, ticker symbol DBMF, which just over the past year, this thing has grown from about $1 billion in assets to over $3.7 billion. It's attracting a lot of investor interest. And so we're going to discuss what a managed future strategy is and why you might want to own this. I'll certainly have Andrew explain why he thinks DBMF is attracting so much investor attention recently. We'll talk about the current positioning of this ETF and what it says about financial markets right now. And then we'll also touch on another ETF that DBi recently partnered with Simplify on, the Simplify DBi CTA Managed Futures Index ETF, ticker SDMF. And I'll just say, if you haven't heard Andrew before, you're in for a real treat. This is someone who knows the markets and the managed futures category inside and out. Now, to start, I will be joined by my good friend, Todd Rosenbluth, head of research at VettaFi. And we have a nice little ETF grab bag for you this week. We thought it might be fun to bat around a number of different topics. And so we're going to get into ETF flows and new launches. There are also some pretty big potential industry milestones on the horizon that we'll tell you about. There's an interesting new ETF entrant I want to get Todd's thoughts on. And then I also have some performance data on emerging market ETFs. And I think we'll get Todd somewhat agitated. So again, this should be a fun conversation. We'll see where all of that takes us. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. All right, so first up is the one and only Todd Rosenbluth of VettaFi, who's joining me from New York, as he always does. Todd, welcome to the podcast. I feel like it's been a little while.
It is. It's great to be with you. I think I was supposed to be your guest at the Exchange conference. I had a conflict. I was on stage, and then my turn in the rotation came back around. But boy, what a year it has been, and we got a lot to cover today.
We do have a lot to cover. And yeah, I think it was February when you were last on here. Looking back, that's got to be the longest gap in appearances on ETF Prime. But yes, ETF grab bag this week. Like I said, I'm just going to tee up these topics and we'll see where that takes us. And I do want to start with ETF flows, which I was checking this morning. Those are now over $750 billion for the year. And listen to this, Todd. If the industry does not take in another dollar for the rest of the year, that $750 billion would still be good enough for the fourth best year ever. Fourth best year, which is wild. So my first question for you is, do you think we're going to hit $2 trillion in inflows this year?
So before I answer that, let me just respond to the numbers that you mentioned. Back before we shifted to having a video option to this, you used to play a teaser. And that was me, I believe, saying $800 billion and counting. That was back when $800 billion for a year would have been the record and was the record. So we're crushing it this year. We, as the overall ETF industry, not although you and I are crushing it too, why not? But investors, asset managers that are tied to it, it's been tremendous. I was prepping for this, and it was closer to 700 billion. Now we're almost at 750, and soon to be $800 billion again. We certainly could hit $2 trillion. I don't know if we will. We're certainly going to come very close, and I believe we're going to set the record. The record is 1.5 trillion. That was last year. This has just been a tremendous year. I don't think we're going to see a slowdown necessarily, but perhaps we'll talk about that on the look ahead. And then in the summer, and then the fourth quarter is typically when we see strong inflows into ETFs, and that's going to get us close. We'll see. What do you think? Do you think we're going to get to 2?
I think that it's probably market dependent. If I had to bet as of today, I think yes, we're going to eclipse that. But obviously, it's going to be dependent on whether the market continues to run. We don't have a major pullback, those sorts of things. But yeah, sitting here today, I do think we're going to jump over the $2 trillion mark. Let me ask you this: so $750 billion, that's the headline number. I'm curious if you dig into flows, which I know you track these pretty closely. Is there anything standing out to you over these first 5 months or so of 2026?
Yeah, so I wanted to take a closer look and see what shifted in the second quarter. So we're close to almost 2/3 of the way through, more than half, close to 2/3 of the way of the second quarter, and we've seen a shift, we saw more of a risk-on environment. So credit within fixed income was particularly popular. Vanguard's suite of corporate bond ETFs, Schwab's 5 to 10-year corporate bond ETF are some of the leading products. Fixed income ETFs in general. And I know you talked about fixed income and this being a year for fixed income ETFs in your predictions. So let me give you a shout out for that. More than 30% of the flows have gone into fixed income ETFs. That's punching above their weight. We've seen growth, or we saw, I guess, and again, the last couple of days have shifted the marketplace a little bit, but growth ETFs return to favor. So Schwab's U.S. Growth ETF, Vanguard Growth ETF, the State Street Spider Portfolio S&P 500 Growth ETF, SPYG, all three of those more than $2 billion in the second quarter. And then the third thing that caught my eye has been thematic ETFs. And I know you talked about it last time, and it's continued to gather assets. The Roundhill DRAM ETF, the memory ETF, has been in favor. But you also talked about space and the UFO ETF. I believe you were with Andrew Channon. And we've seen the Global X Infrastructure ETF, PAVE. So it isn't just technology. We've seen other areas of thematic ETFs gain traction in 2026. And that's really impressive to me, in addition to, of course, the broad building block products tied to the S&P 500.
I think that's a really nice summary. What's interesting to me, if I pull up the top 10 ETFs by inflows this year, there's still a lot of the same familiar names on there. You have the Vanguard S&P 500 ETF leading the way, which I want to ask you about that. You have the State Street Spider Portfolio S&P 500 ETF. That's number 2 in inflows. Number 3 is the Vanguard Total Stock Market ETF, VTI. You go a little bit further down the leaderboard. Number 10, Invesco NASDAQ 100 ETF. So you still have a lot of investors piling into U.S. stocks and really market cap weighted U.S. stocks. Now, some other ETFs on there, you have some short-term treasury ETFs, something like SGov. There are some international stock ETFs, the Vanguard Total International Stock ETF, VXUS. You have iMG, but it's just interesting to me that the market dynamics, there was a lot of talk about them shifting, and I think there has been a lot underneath the surface of the market that has shifted, but it's like the more things change, the more they look the same.
Yeah, just real quick, if I can, you're right. I mean, as big as this industry is, as big as the ETFs are, the leading funds are typically going to be those large, broadly diversified ETFs that are tied to the S&P 500, the total stock market, or the NASDAQ 100. And I think that's a great sign. That means people continue to put new money to work, and there's often new investors, and what they start with are the core and the building blocks. And then it's the level below that often we see catching our eye in terms of the tactical investors. But the strategic investors continuing to buy the S&P 500 is a wonderful sign for ETF growth, in my opinion.
I mentioned some potential pretty big industry milestones this year, and with VU, the Vanguard S&P 500 ETF, I know you and I, we always talk about this. It seems like it comes up all the time, but you look this year, it's taken in $56 billion, and its total assets are now at $960 billion. So this is tracking to be the first $1 trillion ETF, and it could get there fairly soon, assuming there's not a big market downturn. I'm curious if you have any comments on that. First $1 trillion ETF.
Yeah, that would be tremendous. Again, another huge milestone. Who doesn't like round numbers? And so, 200. I'm sorry, $1 trillion sounds a whole lot better than $960 billion. VU set the record and then broke its own record for individual ETF flows the last couple of years. It certainly seems like if the market cooperates, it could do so again. And you're right. If we continue to see the S&P 500 climb higher, what is it? It would only need to, if it got no inflows and it was up an additional 7%, I think for the year. I'm doing the math in my head here. Then we could see $1 trillion on that alone. And of course, VU is going to continue to gather assets.
Another potential industry milestone, and this fits in perfect while we're talking Vanguard and just flows overall. I'm not sure if you saw this, but our friend Ben Johnson over at Morningstar, he posted that Vanguard is now within less than $70 billion of BlackRock for the industry asset crown. And if you look at flows year to date, Vanguard is at 205 billion and BlackRock is at around 135 billion. So by my math, that's a $70 billion difference, which means if we see the same thing the last 7 months of the year, we will probably have a new industry leader. What do you think about that?
So, I mean, people like horse races and playoff races. And so, yeah, it's certainly something that we should be watching. I would note that BlackRock's $135 billion is still tremendous. I'm an old, I guess I'm an old a lot of things, but I'm an old school baseball fan. And yeah, it was the race between Mark McGwire and Sammy Sosa back in the day. McGwire ended up being the one who broke the record. Sammy Sosa still had a tremendous year. And that's still notable to me. But when you flagged that to me, that Ben put that out there, I wanted to just take a closer look and see where the money's been going to BlackRock and where the money's been going to Vanguard. And so if you don't mind, I'll just shout out, you touched on VU and VTI earlier. Vanguard's other popular products are also building block related products like VXUS and BND and VEA, whereas where the money has flowed in for BlackRock, are some of the more tactical oriented products. So you mentioned SGov earlier, GOVT, which is another treasury related product, saw inflows among their more popular products in the top 5. IGV, which is a technology ETF. So you get BlackRock is seeing more of the tactical side, and then the outflows for BlackRock into their S&P 100 product, into the Russell 2000 based product out of TLT. So that's going to perhaps play a role in this, is that money seems to be stickier and in the core for Vanguard, whereas there's some still tactical users of the BlackRock products.
Well, and that's why I think flows overall, there is a certain element of market dependency here. And I think that would tie into this race. I know I think I've been guilty of this. Several people over the years have said Vanguard's going to surpass BlackRock in assets, and it hasn't happened. And I do think if, let's say, we do have a fairly significant market downturn, or we just get a lot more volatility, maybe the tactical nature of those BlackRock ETFs brings a certain type of investor back. We know Vanguard's going to continue to take in money no matter what, but maybe that does shift the dynamics a little bit to where BlackRock continues to hold off Vanguard. So I think you're right to hone in on that. I think that's a relevant factor. I just think, assuming all else is equal, I think we're tracking for Vanguard to track down BlackRock. Whether it happens later this year or sometime into 2027, we'll see.
I don't disagree. I think this is, given the pace of the flows and the market share gains that Vanguard has had, it feels like that's inevitable. But it's a matter of when. We made it this far into it before referencing the word Bitcoin, but BlackRock offers a Bitcoin ETF. If we see stronger interest, then IBIT could be a differentiator and help, whereas Vanguard doesn't offer that, as you know.
All right, you brought up Bitcoin. I'm not going to go down that path. Bitcoin does tend to agitate you a little bit, but I mentioned maybe trying to get you a little worked up at the top. And so I'm going to bring up another topic while we're talking Vanguard, and it's not related to flows, but it is sort of related to Vanguard versus BlackRock. So I have a very nice stat for you on emerging market ETFs. I hope you're ready for this. So over the past year, the iShares Core Emerging Markets ETF, ticker IMG, which I noted earlier, that has outperformed the Vanguard Emerging Markets ETF, ticker VWO, by 17%. Do you know why that is?
I do. It's because South Korea is part of iEMG and is not part of VWO, and it's not even a BlackRock or Vanguard call. It's the index provider that's behind it that plays a role. But let you go further since it was your question, and then I'll respond.
No, you hit the nail on the head. It's South Korea. What's interesting is that if you just look at, say, the iShares South Korea ETF, ticker EWY, that's up over 80%. And so, of course, having exposure to South Korea is going to make a big difference here. What's interesting to me is how many investors do you think look at these two ETFs and assume they do the exact same thing?
A lot of them, and what they're choosing is they're choosing the ETF often based on the expense ratio. They think that emerging markets are emerging markets the same way that the S&P 500 is the S&P 500, and that has historically not been the case. I'm agitated is not the word I would use. I'm excited that we're talking about this because what's inside your ETF is extremely important to me to educate folks about. And if you this year you would have chosen correctly or incorrectly, depending upon whether it had South Korea. That isn't always the case. Of course, if South Korea underperforms, the absence of the exposure matters. But this is not an active decision in the case of Vanguard. This is the index provider, in the case of Vanguard is FTSE Russell, classifies South Korea as a developed market. So if you own VEA, which is Vanguard's developed markets ETF, you have exposure to South Korea, a smaller weighting towards South Korea because it's competing against the heavyweights that are in Europe, the UK and Switzerland and France and Germany, whereas South Korea is, I believe, the third, either the second or the third largest of the emerging markets that you'd find within the iShares suite of products. So it does really come down to looking inside the portfolio and going beyond the expense ratio.
Yeah, and I'm glad you mentioned VEA, the Vanguard Developed Markets ETF, because since that does hold South Korea, and then you look at the iShares Core MSCI EFA ETF, ticker IEFA, that doesn't, VEA has outperformed by about 9%. You mentioned it does have a bit smaller weighting in there to South Korea, but it shows that differential. My take on this, I think you would probably agree, over a long enough time horizon, I think this all washes out. This is index-based investing. You're going to have years when South Korea underperforms. You're going to have years when it outperforms. I think over, again, a long enough time horizon, this washes out. But I think a very important point, when you look at, I mentioned 17% performance differential over the past year. That's meaningful if you're an investor or advisor and you have a decent chunk allocated to emerging markets.
People make choices on ETFs for a number of reasons, as you know, Nate. Cost is one of those reasons. Performance is another one of those reasons. So if you were to look just this year or the past year, as you noted, and you looked at the iShares developed ETF and the iShares emerging ETF versus the Vanguard developed and the Vanguard emerging markets, you would probably end up with both the ETFs that have South Korea in it because it's been working. So you'd be double exposed to South Korea. And then and I'm not saying it will happen, but if and when we see that South Korea underperforms, you're going to be overweighted towards South Korea for unintended consequences or unintended reasons.
It's a really good point, because when you start mixing fund families like that, you do run into that issue. And it's not just Vanguard or iShares. We can name a number of different issuers. I've seen this plenty on advisor statements that we see, where they're mixing and matching these different providers. You may have one for developed markets, another for emerging markets. And sometimes that's fine if you're actually doing the homework, you're going in, looking at the exposure, looking at the overlap in holdings, those sorts of things. But unfortunately, not everybody does that. And so you could be doubling down on certain bets, which is fine if you intend to double down, but not so much if it's unintended and you get a nasty surprise. Okay, let's move on to another topic. I'm going to go with new launches this year, which we're already over 460 new ETFs in 2026. And you can comment on that if you'd like. But what I'm curious to hear is, besides IQMM, that ProShares, the Genius Money Market ETF, which we know has 21, $22 billion. A lot of that is because ProShares is using that as a cash management option, and there are other ETFs, which is great, but that's where those assets are coming from. And then you have DRAM, which you mentioned. Those two are easily the top two launches of 2026. My question for you is, are there any other ETFs that have stood out to you that are new this year?
So I'll go with yes, and I'm going to give you 4 of them that are catching my eye. And one of them is just launched today, so bear with me on that one. But the ones that I'm choosing are probably below the radar for many people, maybe not for you, but for many people who'll be listening to this. What caught my eye is that these are funds from fund families that have an ETF presence that launched a second coming or a sequel or whatever phrase that is appropriate from an expansion. So just to set the stage for where my head is at, don't look at you're welcome to look at the underlying assets under management, but don't judge me on my choices based on that. And so the first one is the Sprott Rare Earth ex-China ETF, REXC or REXC. To me, this is a more targeted, politically sensitive sibling of the Sprott Critical Materials ETF. That ticker is SETM. This ETF from Sprott, the ex-China ETF, is more concentrated. It's focused on rare earths, which is extremely popular. It supports the defense industry. It supports technology sectors. Rare earth materials are in the supply chain is extremely important. But China has a monopoly or a near monopoly on rare earths. And so we think as investors are going to look towards other ways to get exposure, you might recall that when Trump was previously negotiating with China, rare earths was a hot topic. This ETF from Sprott caught my eye. It allows people to get a more targeted exposure to work around that issue. So that's my first one. Do you want me to go through all 4 of them, or do you want to comment?
Yeah, I want to hear what else you have.
Okay, so you mentioned emerging markets earlier. So I have 2 that are emerging markets related. They're both actively managed. The first one is from T. Rowe Price. Their Emerging Markets Equity Research ETF. The ticker is TEMR. This is relatively new. It's relatively small, but what caught my eye is T. Rowe Price crossing the $25 billion asset mark this month, helped by the T. Rowe Price U.S. Equity Research ETF. The ticker on that is TSPA. So this is new fund. TEMR is the emerging markets cousin that you'd find. Again, bottom-up fundamental approach. T. Rowe Price has a team of analysts that pick stocks. They are chosen for the ETF based on the weighting of the sectors. It's a fundamental approach to emerging markets from a firm that has been investing in emerging markets for years. And I just think that's interesting to see the emerging markets comparable to a successful U.S. product. The third one is also emerging markets. It's the Barron Emerging Markets Select ETF, BECM. I think you had the Barron team on recently. They made a splash when they entered the ETF marketplace in December. And has had some success. And I always love it when a firm comes back with new products relatively quickly. The manager for this Barron ETF also runs a roughly $4 billion mutual fund that has a 15-year track record. So I think that's quite compelling and interesting to see if Barron can translate the success into the ETF wrapper. And then my last one, it just is launching today. I believe it launched. Let's hope it did. Is the Tuttle Heavy Asset Low Obsolescence Index ETF. The ticker on that is HALX. You might have heard of the Halo trade. I think Josh Brown coined it. But it's interesting. This is the AI disruption or trade and being immune to it. And in full disclosure, VettaFi is the index provider behind that. So I just wanted to shout that out because it's pretty cool that there are index ETFs that continue to launch. I know we talk a lot about active products. That was a lot. If I had water here, I would drink it, but I don't. So let me take a pause and let you comment about my under the radar picks.
Yeah, that's an eclectic mix of ETFs. I like it. The Sprott Rare Earth ex China ETF I think is interesting. I actually highlighted that a few weeks ago just as part of this AI infrastructure trade, because clearly rare earths are a key component there when you think about really everything across the AI infrastructure trade. So I like that one. I think that's definitely going to get some looks. The emerging market plays, again, it gets into performance. I think those could be very timely launches just because emerging markets have performed very well. And with Barron in particular, I love what you said, that they have followed up their initial success by bringing new products to market. I always think that's a good recipe. I think sometimes issuers should be a lot more aggressive in that approach. And Barron, you look at the total assets their ETFs have taken in so far, they've had a very successful initial debut. So the Halo ETF, I like that. That's a good one if you want to go sort of on the other side of the AI trade, to your point. So no, I think that's a good mix. Since I didn't get you agitated enough in talking the emerging markets ETF with Vanguard and BlackRock, I'll point to two ETFs that have launched this year that have caught my attention. Are you ready? You're going to be surprised. They're crypto related. Morgan Stanley Bitcoin ETF, ticker MSBT. Just because this thing launched so much longer after the initial wave in January 2024, and it's already pushing 300 million in assets. I think that has a really long runway. And then the iShares staked Ethereum ETF, ticker ETHB. Last I checked, I think that had $800 million in assets. And I think that's pretty remarkable given that iShares also has the largest non-staked Ethereum ETF in ETHA. And so to see that kind of success with a staked version, I think is pretty impressive. By the way, I have to ask you, did you see all of these ETFs launched by Corgi? It was something like 35 or 40 ETFs, and they literally have hundreds more in registration with the SEC. But the ones that they've launched are primarily buffer and thematic ETFs. And the interesting thing is, if you look at the expense ratios on these, they're all priced very attractively. And so they're essentially blanketing the market with these lower cost products. I'm curious, did you have any thoughts on that approach?
I do. So it comes back again to choosing an ETF based on the expense ratio and, in my opinion, the flaws of doing that, especially with thematic ETFs. I know we gave the poster child example of emerging markets because it's up to the index provider behind it as to what country is classified as developed or emerging markets. In thematic investing, the devil really is in the details. And so I've got a couple of quick case study examples folks can look up on their own. But in the defense technology space, Global X is the largest product with Shield, SHLD. There's an ETF from Rex. The ticker is Drones, or DRNZ. Shield's fee is 15 basis points lower, and Drones is outperforming it by over 1,000 basis points this year. So it is very much what's inside the ETF that matters. A second one, since you talked about AI and AI adjacent, NLR, which is the VanEck Uranium and Nuclear ETF, is 33 basis points cheaper than Nukes, NUKZ. That's a Range of Resources ETF, but it's trailing Nukes by 400 basis points. So what's inside a thematic ETF is more important. So I realize I'm not touching on Corgi intentionally. I don't know all about what's inside it and how it's performed. They're relatively new, but investors should not buy an ETF, a thematic ETF, looking at this is the cheapest way to get exposure to it. You can do so, but you're certainly going to end up with something that might perform quite differently than the larger products.
What a surprise. Todd Rosenbluth is going back to the know what you own theme. I love that. I have to mention on the topic of thematics, I think it was an article that you wrote where you had mentioned the VettaFi Asset Allocation Summit in April, where VettaFi, as you always do, you polled advisors on a number of topics, and this one was on asset allocation. And it was really interesting to me. 35% of advisors said they expect to add thematic ETFs in the next 3 months. And what's noteworthy about that is that's more than those who chose fixed income or commodity ETFs. That's pretty wild. I bring that up in the context here because I think there's clearly demand for thematic ETFs. We went through this period where maybe momentum slowed a little bit, but that feels like it's coming back. And so you look at Corgi launching into that environment, and then just the proliferation we've seen in thematic ETFs overall. The timing is probably pretty good.
Yeah, and so that was something we asked, I guess that's about a month ago. And since then, I mean, DRAM proved the point. I don't think that people weren't necessarily picking that ETF, but I think the success that fund has had and other thematic ETFs showing that you can add value and you can add some satellite offerings to complement your core S&P 500 based products and have it work, not just on the AI theme, but other themes. I think we're going to continue to see growth in thematic investing. We've seen it this year. I expect that it's going to continue.
All right, real quick, besides the growth in thematic ETFs, anything else in ETF land that has you particularly intrigued to watch over the next few months?
Well, so it's connected to the ETF land. Obviously, we've got a new Fed chair that's coming in. There was expectations that rates would be cut on his watch. Now, the last couple of days, the next move by the Fed is expected to be a hike by more people. That is certainly going to shift the environment. You and I were talking about how can the market go? How can the ETF industry continue to grow? Well, it matters how the underlying stock and bond market shifts. Rising interest rates certainly is going to play a role. It's going to play a role in terms of value relative to growth. It's going to play a role in taking on interest rate risk or not. And so I'm just watching that to see how market expectations are. And then if I can just come back quickly to something you had as a prediction, was that smart beta ETFs make a comeback. And I just want to compliment you on, you're right. It has. So even though we've seen some net outflows, RSP, that equal weight Invesco ETF, still has $7 billion last I looked of net inflows. The momentum ETF from iShares, the mid-cap momentum ETF from Invesco, Victory Shares has had success in smart beta. There's a lot of smart beta success stories. And if the market turns more value-oriented, there's a whole swath of them that have a value tilt or leaning to it that I think are going to be all the more relevant. So I'd love for you just to make a quick comment on smart beta making the comeback that you had hoped it would.
I just love that you have called out two of my 2026 predictions between that one and the fixed income ETFs. So that it looks like I've got a pretty good start here to have some success on my predictions this year. Yeah, smart beta ETFs. I continue to say I just think for a number of reasons, whether we talk the concentration and the market cap weighted indices, I do think there are still some concerns over valuations. We can talk about how rates and inflation play into that. I just think investors may be looking at different ways to get exposure to a similar universe of stocks. And maybe they want to put a quality screen on it, or take a value tilt, or take a small cap tilt, those sorts of things. And we always say smart beta allows you to do that without taking on the emotion of a traditional active manager. And that's why I was bullish. So I would even pull in smart beta. I casted a wide net here in that I think ETFs that are technically classified as active, but they're really quantitative in terms of how they're implementing the investment process, those fit in the same boat here. I put those in with just a pure rules-based process as well. But I just think those are going to continue to get more looks moving forward. The other thing, real quick, I'll comment on with the new Fed chair and rising rates. Take a look at TLT, because I've beaten the table on this. Everybody knows I don't have a crystal ball. My crystal ball is broken, but I've been so reluctant to take on duration risk over the past couple of years. And TLT still in the midst of like a 40% drawdown, which is just remarkable to me. I've called that the widowmaker trade. So imagine if we continue to get rates moving up, especially on the longer end of the curve. That's going to be a rough place to be. But Todd, we're going to have to leave it there. Always fun to chat. Nice ETF grab bag this week. Thank you for joining me.
It's been a pleasure. Have a good one.
That was Todd Rosenbluth, head of research at VettaFi.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
I'm now joined by Andrew Beer, managing member of DBi, who is behind the iMGP DBi Managed Future Strategy ETF. The ticker symbol, DBMF, which this is now over $3.7 billion in assets. It's actually tripled in assets just over the past year. It's easily the largest managed futures ETF on the market. And then I should note, along with that, DBi recently partnered with Simplify on another ETF, the Simplify DBi CTA Managed Futures Index ETF, ticker symbol SDMF. So I'm going to get into both of these with Andrew, who is joining me from Connecticut. Andrew, it is great to see you again, and welcome back to the podcast.
Thank you. It's great to be here. I really appreciate you having me back.
All right, so managed futures. I've got to tell you, my sense is that when some investors and advisors hear that term, they automatically tune out, but not for any negative reasons. I just think it's because they assume this is too complex, right? They put this in their too hard bucket, and so managed futures don't end up in their portfolios. Now, obviously, more investors are figuring this out given the asset growth, the DBMF I just mentioned. But if you don't mind to start, let's cover some basics here before we get too deep. Can you please just explain managed futures to everyone? What does this mean?
Sure. So first of all, it's the worst naming convention ever for a strategy, because you're right. I mean, nobody really has a visceral feel for really what they do. But and I came at it I came at it sort of as an allocator. And when I talk about the space, I really first of all talk about what it does and how it does it. And what it does is it's a strategy that, like a lot of great hedge fund strategies, is trying to be early, contrarian, and right with big changes in the world. So when inflation comes back, you want to get in front of that. When gold comes back as an asset class, you want to be in front of that. In January of this year, before war breaks out in the Middle East, you want to get in front of being long crude oil. So, that's kind of what it does. And from a portfolio perspective, the reason I, as an outsider, fell in love with the space is it's very, very hard to find something that has zero correlation to stocks and bonds and does the best in a year like 2022 and generates a lot of what they call alpha over time. And to me, what's interesting is the way that the underlying strategy works is you've got, the people who do this for a living, and we can talk about how we do it. It's a little bit different. But what they do for a living is basically they analyze tons and tons and tons of price moves across the markets. And they feed basically all of this into this systematic models to try to understand, look, if gold has been going up, is it going to keep going up? Is oil going to keep going up? What's sort of the smart money in the market telling you about where the big moves and big money making opportunities are going to be? And so to me, it just, when you look across the panoply of things you can add to a portfolio of stocks and bonds, I just haven't found a better diversifier. Something that works so well when the rest of your portfolio is not working.
And in terms of implementing these strategies, why use futures contracts versus, say, holding other ETFs? Now, I understand the strategy is called managed futures, but again, bear with me, just for educational purposes, why not managed ETFs, for example?
Sure. So futures contracts are some of the deepest, most liquid markets in the world. Like, it's much easier to buy a futures contract on the S&P 500 or the 10-year Treasury bond than it is to actually go out and buy all the stocks of the S&P 500 or even ETFs that do it. And so the strategy is a very actively traded strategy. And so it grew in the most liquid markets, because you can imagine if you're trading a lot every day, trying to figure out where the next opportunities are, you can get chewed up over time if your transaction costs are high. So futures are in this corner of the markets where if you're a big institution and you're worried about equities going down or you want to hedge your positions, you go to these markets because they're the deepest, most liquid markets. Plus, it's as easy to bet on something going up as it is going down. And you have them not just in things that we know like equities and bonds, but also in gold and oil. I mean, no one goes out and says, how many deliver all the barrels of oil to my garage. You buy futures contracts on oil. People don't generally go out and buy gold bars and try to stuff them under their mattress. You go buy futures contracts on it. So it's the liquidity and the ability to articulate these bets on the world is really why people go into the futures market. As an allocator, it doesn't matter, right? What as an allocator, what you care about is this going to help me? Is this going to make my life better? Are my clients going to be better off from it? This is just the machinery by which people can make that happen.
Okay, so now that we have that background, let's talk about how you are implementing this managed future strategy, again, via DBMF, the iMGP DBi Managed Future Strategy ETF. What are investors going to find here?
So we came in it from a very different direction. So the way that I saw the space back then, and I have a long history in the hedge fund industry, and I've done a lot of different things. But when I came at it, the way I thought it was, it's a tremendously valuable strategy that can get these calls really, really right. But the way that most firms implement it is very inefficient, and it's too much trading. Too many instruments, et cetera. Like at the end of the day, I like the simple bet. If inflation is coming back, then I want to bet on treasuries going down. Back to your point about TLT, I want to be on the other side of that. I don't need to do it in 25 different ways. So what we do is actually we try to build what we would call sort of the efficient beta of the space. And the beta of the space is by looking at how all these managers across the space are positioned. What the smart money is thinking about the direction of interest rates, the direction of oil, the direction of gold, the direction of equities. And we, on a weekly basis, take that and synthesize it into a very simple portfolio that we then have in an ETF where you can see our positions every single day. So you'll see relative to most people in the space, you'll see a very, very clean and simple portfolio, which is basically short-term treasuries with 10 futures contracts and you can see how much we're exposed long or short to those instruments.
And out of curiosity, you mentioned the potential for inflation continuing to reaccelerate. How is this ETF currently positioned, and what is that telling you about how these leading hedge funds are interpreting financial markets at the moment? What are some things that stand out to you?
Well, look, if you read anything about the markets right now, the markets are a little bit schizoid in that you've got alarm bells going off with where crude oil is. And again, people are talking about crude oil could very, very easily go up to like 150 from here if things are not resolved. And guess what? That's really bad for inflation. And so you basically have two bets on. One is that if crude oil goes up a lot, it's good for these portfolios. And if interest rates go up a lot, it's good for these portfolios. On the other end of the spectrum, they're optimistic about equities. And so again, so in a sense, they're reflecting this conflicting view of the markets that the S&P has been on a tear. And you look at what's happening with AI, and you look at what's happening with earnings growth, and you look at all these things, even though valuations feel crazy and stretched to a lot of different people, there is a great deal of optimism in the equity markets at the same time as that there's also a great deal of fear about these other areas. And so that's what you get in a strategy like this is trying to, again, identify and leverage these different investment opportunities that you're not going to see in a typical 60-40 portfolio of stocks and bonds. That's why it's different. That's where the diversification comes from.
Yeah, and just talk a little bit more about that. You were mentioning earlier how a managed future strategy performed in, say, 2022, when we know both stocks and bonds went down fairly significantly together. You talked about the lower correlation to equities and fixed income. I just really want to emphasize what is the investment case for an ETF like DBMF? Like, why should investors and advisors consider this?
95% of people out there, when they look at their portfolios, 98% of people are going to see stocks and bonds. And that combination worked magically in the 2000s and 2010s. If stocks went down, bonds would go up. Stocks go up, bonds, we were even still going up a little bit. And so the combination of those worked flawlessly. What happened when inflation came back was they both went down at the same time. And so the playbook around diversification stopped working. And frankly, that's been true for a lot of this decade. And right now, bonds are down for the year, and equities are still up. But the fear of inflation is everywhere at this point. Because the way that I've described what managed futures funds do, they may be thinking about changes in interest rates or commodities or interest rates going up or down, or these kind of big macro themes. They really do march to the beat of a different drum. And so the person who's building that model, which in order to help you to grow your assets with less risk and to sleep at night, they're thinking about things that function differently and how you put together the package. 1 + 1 + 1 = 4, basically. And when you look at this strategy, it has what I call more diversification bang for the buck than anything else that I found that you can make work in a liquid or low cost ETF. So what's happening is basically across the wealth management space, people who never would have looked at this are saying, you know what, I need 3% of that, or I need 5% of that. And maybe they've also said I need 3% of gold or 5% of this. But this push toward diversification is what's driving interest. And what's happening now is BlackRock, Fidelity, Invesco, the giants are launching their own products, and they're starting to say this is just something that every portfolio should have 3 or 5% of, because it adds that kind of value over time.
I want to ask you about some of that other competition that's entered the category, but real quick, just going back to portfolio application and how investors should think about this. One question I have is just around investor behavior. And the way that I would lay this out, which I think is very straightforward, is obviously these strategies will have periods of underperformance, right? Sometimes long periods where they just don't work. And obviously investors need to stick with these strategies in order to receive the quote unquote payoff during the good times, right? When these strategies outperform. I'm just curious, do you find yourself talking a lot about that with clients, just the behavioral side? How important is that when implementing managed futures?
We've had an incredibly loyal and sticky client base over time because we are talking to people who themselves are long-term thinkers. They're people who build model portfolios, and they generally know you can't time this. Like no more than you can time whether the S&P is going to be up over the next month or two. So the pitch or the discussion is always, look, you are building a long-term what's called a strategic asset allocation model for your clients. And you want your clients and everybody else looking out into the horizon, because your goal is when that person retires in 10 or 20 years, you're trying to help them have as much money as possible and to have as smooth and safe a ride between here and there. And this can help, but it can't help if you're in this year, out next year, come back in 2 years later, because it doesn't work that way. Because the strategy itself is tactical about getting in front of things that by definition other people don't see well. So we started to see in the strategy, just looking at our positions, we started to see the signs of inflation in September of 2020. Think about how early that was. Right. We are betting at that point. We are seeing that the price signals that these guys are picking up on across the landscape suggest that interest rates are going to go up. The 10-year Treasury yield was only 70 basis points at that time. It went up 400 or 500 basis points from there. And so I think when I talk to people is that you should view this just as the things you put into your portfolio you expect to have for the next 10 years, and let it do its job. Now, one of the interesting things about protecting yourself from periods of underperformance, every strategy goes through periods of outperformance and underperformance. But when I looked at the strategy, I said, you know what? If I'm investing with high-cost hedge funds or high-cost mutual funds, that are burning through a lot of returns by trading hundreds of instruments every day, right? Then guess what? In a lower return period, everyone's making money but me. Of course, I'm not going to make money. But so my protection in that is I'm going to do what you do, but copy it so cheaply and efficiently that even during the dark periods, I'm still doing well enough, so that I'm there during the good periods when I do great. And so back to your point about 2020, the whole space was up, but what I was actually most proud about in the preceding years, we're still making money for people in what was a tough period. But then you get to 2022, and the strategy's up north of 20%, everything else is down, and we should call it a beacon of green in a sea of red. Nothing's working from a diversification perspective. Gold didn't do anything that year. Your tips were down 15%. Your commodities were up, but like your REITs were down 30 or 40%. So a lot of the playbook diversifiers that people put in their portfolios weren't working, but this was. But you've got to have been, you can't invest, you've got to be there. You've got to be waiting for it to happen.
Well, again, the good thing is clearly your message and the education around this is resonating because, as I noted at the top, you've seen assets in DBMF go from over $1 billion to $3.7 billion just over the past year. So that's good to see. Real quick, I did want to ask you about the other ETF I noted. So besides DBMF, earlier this year, you partnered with Simplify on another product. That's the Simplify DBi CTA Managed Futures Index ETF, ticker SDMF. Maybe talk a little bit about that partnership, and then I'm curious what's different about this ETF versus DBMF.
Sure. So it's the same underlying strategy. It's the same underlying, but it's a different implementation. So the big ETF that we manage is an active ETF with an 85 basis point expense ratio, which is great. It's about half the price of the mutual funds that were out there. And so, and obviously, as you know from your podcast, the active ETF world has been taking off. Okay? No one on planet Earth has solved a problem for trillions and trillions of dollars of passive, low-cost ETF models. How do you get diversification in there? Okay, because most active and other products are just simply priced out of those portfolios. So this crazy vision that I had about 10 years ago was, I want to be able to deliver the best diversifier at a price point that is consistent with the passive ETF world, that is an index-based product, that is, and more tax efficient, as tax efficient as you can make it. And so I spent about 2 years doing a lot of talking to people and doing a lot of engineering about, and so it turns out that we can actually, our strategy can be made into an index. And so what Simplify did is they launched an ETF that basically gets exposure to our index. And that basically solves those three things. Their expense ratio comes in at 35 basis points. It's a passive ETF tracking an index, and you can look at the index and plug that into your models and decide how much of it you want in your portfolio. And then the way that they implement it ends up being somewhat more tax efficient. So for me, it was kind of bringing together these, and Simplify for us was a great choice because they're at this intersection between ETFs, derivatives, tax optimization that you hear all stuff about all day long, and so I reached out to one of the founders and he said, we love this idea. We think we can change the world by bringing a solution to everybody out there who has ETF model portfolios, bring them all this diversification in a package that will be appealing to them.
A few minutes left here. So how should investors think about allocating to DBMF versus SDMF? You clearly laid out, the active versus passive and some of the differences there, but I'm just curious, high level, how investors should think about that. And then I'll fold in what we were alluding to earlier, just in terms of the competitive environment overall, in that there have been several pretty big players that have entered the managed futures ETF category, some of the largest asset managers out there. And so what should investors be considering if they're looking at DBMF versus SDMF, and then versus some of these other products altogether?
Sure. So DBMF versus SDMF is the decision is, first of all, both strategies, 5 years from now, they should have essentially the same returns. How sensitive are you to fees, to headline fees? How do you prefer passive versus active? It's a lot of it has to do. Every advisor that I've spoken to, every allocator, has a different client base who's expecting different things from them. Some are more active focused, some are more passive focused, some are more concerned about headline fees, some are less concerned about it, some are more concerned about tax efficiency than others. I think what you should do is just look at both of them, understand it's the same underlying strategy and see which package works best for you. What I'm seeing is that, some allocators, it's really important to have a fund with a 7-year track record that is huge, by far the largest, sort of quote unquote hedge fund ETF in the world I think it's ever been. And, and for that's critically important for them. It's the easy allocation. For others, incremental savings from tax efficiency matters enormously to them and their clients. Or they've got, very, very low cost portfolios where the headline fee is critically important to them. So, what I think is, I think we built a mousetrap that delivers what it's supposed to deliver, but I recognize that different investors have different preference functions and criteria, and so we're trying to make sure that we have the right vehicles for them to gain exposure to it.
And then what about, again, just this additional competition that's entered the space? Obviously, your strategies, you're going to say, hey, look at DBMF or SDMF, as you should. So maybe I'll frame the question, what should be some key considerations? If I'm an advisor or an investor, I go to allocate to manage futures strategies via the ETF wrapper. I see a number there. What should be some due diligence checklist items?
So first of all, you should reach out to me and talk to me about it, because I came in from your side of the table, and I'm phenomenally positive on these big firms coming into the space, because the question for the space is not, we know the space worked, right? It's works for 50 years. Right? The issue is there needs to be more education about why you want to have the space in it. My general view is that a lot of this space is sold on complexity. And there's a perception that complexity is A, going to deliver better returns, and B, therefore you should be willing to pay more for it. I haven't seen it. Right? It's actually, to me, simplicity and efficiency wins. And if you look at our numbers, right? So you look at our numbers, we've managed to beat the hedge funds who've been doing this for a living for decades by 300 basis points or more a year, like doubling, just purely by basically saying, we love the idea, but it's time for a technological innovation that makes this more efficient. It's enough of all these layers of fees and expenses before clients end up getting paid. It's your money. We're going to deliver as much of the return back to you as we can. And so I love other people coming into the space because they validate the space, but I think our products are better.
All right. So the takeaway, call Andrew. And I will say, I love what you said there, in that I do think you've really made managed futures approachable to investors. I think that comes across just in our discussion here. And I think that is really important. Simplicity always trumps complexity. So really appreciate you doing that. Excellent discussion. Always so great to connect. Thank you for joining me, Andrew.
You're the best. Thanks so much.
That was Andrew Beer, managing member of DBi. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I'll be joined by Rich Lee, head of program trading and execution strategy at Baird. So we're going to have an interesting conversation around index providers changing their rules to accommodate big IPOs such as SpaceX. And we'll cover several other ETF topics as well. And then I'll also be joined by Doug Baker, portfolio manager at Nuveen, who's going to spotlight their preferred and income ETF. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova DS Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.